It's a lot of work, but we obviously have the capability to do that, and we have the capability to do it in WAMU. I think we finished the WAMU consolidations in 9 months, all of them. So that within 9 months, that we're all in the same systems, which allows you to start doing a better job in customer service and things like that.
So this fortress balance sheet strategy and raising this equity capital and having additional margin of safety and conservative accounting, in retrospect, it seems like the obvious right strategy for running a large financial institution. Why wasn't everyone else copying it? Have people changed, and does everyone else run their banks like this now?
I think the people are more conservative today. I think regulators are more conservative today. But again, I go back to people get involved in aggressive accounting. They don't look at stressing their own bank in a real way. You saw people take too much interest rate risk, too much credit exposure, too much optionality risk, or sometimes it's new products. So if you look at the financial services, very often it's the new products that blow up. It takes a while. They haven't been through a cycle. And you had that with equities way back in 1929. You had it with options. You had it with equity derivatives. You had it with mortgages. You had it with even Ginnie Mae's at one point blew up, even though they're government guaranteed.
Arguably, you had it with quant and with LT.
It happened with the quant. It happened with leveraged lending. And then people then become more rational how they run these balance sheets and how they think through the risk.
So I have to ask you, is this private credit today?
Say it again?
Is this private credit today?
I don't really think so. I don't think it's $2 trillion. It's grown rapidly. That's an issue. But what happens, the other thing about markets, there's some very good actors in it who know what they're doing. Customers like the product. So I always say, well, the customers like it. But there are also people who don't know what they're doing. And it's grown rapidly. So there may be something in there that would become a problem one day. I don't think it's systemic. So that $2 trillion, the mortgage market, when the time it blew up was, I'm going to say $9 trillion. And $1 trillion was lost. This is, and it was
$1 trillion was also
in a highly
more
leveraged
than $1
system.
trillion back then.
Yeah, a lot of these private credits are not leveraged like that. But that doesn't mean there won't be problems, but it's slightly different. But you look at the whole system. There are other things out there that are leveraged that can cause problems. And of course, people take secret leverage in ways you don't necessarily see it.
What are some of these in your mind that are potentially problematic today?
Well, I look at. When you look at asset prices, they're rather high. Now, I'm not saying that's bad, but if today PEs were 15 as opposed to 23, I say that's a lot less risk, a lot less to fall, and you have some upside. I would say at 23, there's not a lot of upside, and there's a long way to fall, and that's true with credit spread. So, we stress test everything. We do like 100 stress tests a week, and to make sure we can handle a wide variety of things. And then the other thing, and the biggest risk to me is cyber. I mean, I think this cyber stuff is, we're very good at it. We work with all the government agencies. They would say that JPMorgan, we spend $800 million a year or something on it. We educate people on it. We just do. But you're talking about grids and communications companies and water, and even part of the military establishment. The protections are not what you need if we ever get any kind of war where cyber is involved. And China is very good at it. And so is Russia, but Russia is mostly criminal, which is slightly different.
All right, I'm going to pull us back to the story. We're going to fast forward to 2023.
We're not really equipped to talk about Russia, so it's not what we do on Acquired. But
Silicon Valley Bank
yeah.
and First Republic both fail. You're there again. Did you see it coming? What lessons did you learn from how 2008 went that you could apply in 2023? Obviously, you bought First Republic.
Yeah, so Silicon Valley Bank, both Silicon Valley Bank and First did some very good stuff, but they both had something unique that we didn't know at the time. And I'm going to call them concentrated deposits, not uninsured, because people are misstating that concentrated. And so a lot of venture capital, and what happened with Silicon Valley Bank and kind of First Republic is some of these large venture capital companies, call them, there are hundreds of them, maybe 1,000, told their constituent clients that they invested in, who all banked at Silicon Valley and First Republic, the banks aren't safe, get out. And they all removed their deposits. In Silicon Valley Bank, I think they had 200 billion in deposits, 200 billion, 100 billion in one day. And that caused the problem, but they also had other problems. They didn't have proper liquidity. They didn't have their collateral posted at the Fed, and they had taken too much interest rate exposure. And the interest rate exposure was hidden by accounting. It's called held to maturity, where you don't have to mark even treasuries to market. And I always hated held to maturity because, but it gives you better regulatory returns and stuff like that. But when that held to maturity, if you said, what's the tangible book value of one of these banks? And you said it was 100. Well, all of a sudden it was 50 if you just marked that one thing to market. And there's now you're into judgment land. At what point, if you saw a bank where just that one mark had the tangible book value drop to 40 or 30 cents in the dollar, would you panic? I would have said that's too much risk. And the regulators helped us because they said rates are going to stay low forever. So these banks bought a lot of 3% mortgages. And when 3% mortgage, when rates went up to 5%, worth 60 cents in the dollar or 50 cents. And that was it. And so both those they took too much interest rate exposure, known to management, and it was known to the regulators, and and fixable. So we knew a little bit about Silicon Valley Bank. We were trying to compete in that area, so we learned a lot afterwards about how to do a better job for that ecosystem of venture capital. We have a whole campus in Palo Alto now. We've hired 500 innovation bankers. We cover venture capital companies. We're not as good as they are yet. We're going to get there because we're organized slightly differently. And we knew First Republic. We were watching it. I had called Janet Yellen. I said that company's in trouble, and one or two others. If you want to, we'll take a look. We could probably buy it and eliminate the problem. They waited a little bit too long. It was kind of a little melting ice cube. But you can imagine, the day we bought it, you never heard about it again. We hedged all their exposures in a couple of days, and we merged everything. We wrote everything down, but we did get some good stuff from it. We actually got some good people. The normal thing in acquisition is they're terrible, get rid of them, or they failed. But we also looked at what they did, how they dealt with clients. Some of maybe clients here, they did a great job with high net worth clients. Single point of contact, concierge services. So now if you go down Madison Avenue, you see things called JPMorgan Financial Center.
That's your first JPMorgan branded consumer effort, right?
Yes. Because it's kind of based on that. When you walk in there, we know your small business, we know your mortgage, we know your consumer banking, we can get you travel, we can do a whole bunch of different stuff. So very high level services. I think we have 20 of them now, but I'd love it. And if it works, in 20 years we'll have 300. And so these things are opportunities, and I hope it works. You don't always know they're going to work for a fact, but so far, so good.
All right, so we're effectively caught up to today. And if we're trying to, and now we've got the whole story, we've got a lot of context. Obviously, didn't go into every detail. But if we're now trying to answer, if we're now trying to answer the question, how did you separate from the pack? Why did you become a completely different animal than your whole competitive set? What are the things in your mind that led to this success?
Well, I don't know totally. First of all, because we skipped over strategy a little bit, and this is important for you all that we have. What we do is the same thing that a community bank does, other than investment bank, global investment banking. Okay, so if you walk into a small community bank, they know your business account, they know your consumer account, and they usually have a trust company. They used to call it trust. They'd manage your private affairs. They'd set up a trust for you, and they do stuff like that. And their CRM is up here. They don't need a Salesforce CRM because they know everyone in town. And they didn't do big-time global investment banking, but the strategy, those businesses fit together, they feed each other, and so does investment banking. A lot of our middle market clients use investment banking products. A lot of our consumer clients use some FX. So all of our businesses feed each other. There's no extraneous. We got rid of everything that didn't fit a strategy. And then you start building client businesses and client services, fortress balance sheet, fortress accounting, all those various things. And I've always talked about.
So it's holding a portfolio of things that actually feed each other.
They actually fit. Whereas, Citi had consumer finance, that didn't fit. Life insurance, that didn't fit. Property casualty, that didn't. They eventually got rid of them all. Sandy just wanted to do more of them. He bought American General, which did truck leasing, for God's sake. And once you get involved in these things, it's hard for people to understand the risk in each one of these businesses. But all of ours fit. I don't like hobbies. I don't like things. We've made plenty of mistakes because you have to try and test things. And then you're always investing for the future. That investment is always people, branches, and technology. And that's true whether they're investment banking people or consumer bank people or opening consumer branches, or I think Doug Penno's here and Troy Rohrback, who run the Global Investment Bank, but they've opened commercial banking branches all over Europe. And I think you're telling me it's going great. And it's feeding all other parts of the company. So just sticking to your knitting, constantly investing, not overreacting to the market. Markets are like accordions. And then sometimes, if you're strong when others aren't, you have a chance to buy things you want to buy. And then always look at the world from the point of view of the consumer. What do you want? How do you want it? How do you want to get it? Can we provide it to you in a way that makes sense for us too? Not going for the last dollar and nothing like that. And so, and building teams of people. Our people are curious and smart. They have heart. They have soul. They give a damn about the guards in the company and the receptionists. And it's not just about the big time bankers and people pounding their chests. We don't try not to put up with that. And we have big time bankers. They are exceptional. But the company, serves the clients, and we have, and I think the clients know that.
When you really dig in to start analyzing JPMorgan's financials, you kind of see this one thing that jumps right out at you, which is the efficiency ratio. For every dollar that you make compared to your competitors, you get to keep 15 cents more of that dollar as profit. It's not hard to see how that compounds and how that allows reinvestments. And why is your efficiency ratio so much better than competitors?
It is literally continuously investing and gaining business at the margin and not stopping and not starting. And the thing about margins too is that we have that margin while investing a lot. It's much easier to have that margin and just, we can cut billions of dollars of marketing out tomorrow. We can stop opening branches and save $1 billion next year. We can do a lot of things. Your margins will go up, your growth will go down, your long-term margins will probably get worse. So we kind of look right through the cycle and we look at the actual economics of what we do, not the accounting of what we do. And we've built it over time. We have great people and great products, and there's some secret sauce I'm not going to tell you about. We do Investor Day, and we tell everyone everything. And I'm sitting there watching I never do presentations. I'm watching them do the presentations. I'm saying, oh God, we're just giving away too many secrets here. But
so there's secrets as to why the efficiency ratio
I
is so
saw
good.
Howard Schultz here before, and I'm not supposed to say that probably.
It's okay. It's okay.
But
we're glad you invited your friends.
Look what he built over the years. The consistency, the curiosity, the heart, the branch by branch products. It's just always doing that, knowing you're going to make mistakes, but building the culture that just kind of plows through that. And you all know, I do use sports. Sports is a great analogy. If you have a sport team with a bunch of real jerks on it, are they going to be a great team? Almost never. If the team members aren't giving it their best every day during practice, you look at Tom Brady, every day at practice he worked hard.